Let's move on then. The market is still holding firm at about 100 points higher on the Nifty. Ravi Dharamshi is CIO at ValueQuest Investment Advisors. He is now joining us. Ravi, hi, good afternoon. Thanks a lot for joining us. What explains this massive resilience that our market has shown? I mean, so much has been thrown at it: dollar index, bond yields, the big weakness in the US market. Nothing seems to bother.
Yeah, thanks Anuj for having me on the show. I would just say that during the time when the world was enjoying the growth, we were actually going through a lot of pain. If you roll back to 2017-18, when US was going through fantastic growth phase, we were struggling with our domestic issues like GST, demonetization, IL&FS crisis, one after the other things, which actually destabilized the economy in the short run. Now those things are actually acting in favor of the economy with the consistent GST collections that we are seeing about 1.4 lakh crores. Tells you that the engine is finally cranking up. Our economy is actually doing well. So when in a scenario when the world is actually slowing down due to geopolitics, due to inflation, due to interest rates going up, and the commodity prices also, India is actually in a position to take that blow in a better position, in a better way than most of the world, developed world is. So when COVID hit, most of the world actually went and printed money left, right, and center. Well, for various reasons, good or bad, we actually did not do that. So not too much of demand stimulus was provided. We actually focused on only giving a protection to the lowest at the bottom of the pyramid. So that is what is actually holding us in good stead, where we are not having a runaway inflation, and we had more than kind of 10-11 months of buffer in terms of forex reserves with RBI in terms of imports. Now that has come down to close to 9 months, but I think we still have decent enough cover. So our rupee has been stable, inflation has not been runaway, and we could actually provide counter-cyclical measures in terms of cutting excise on the fuel when the fuel actually went up. So all those things have kind of helped us in managing our balance sheet, and the domestic cycle is improving on many fronts, from manufacturing to real estate to financials. Finally, the credit growth is coming back. So multiple factors, and we are actually positioned in a counter-cyclical way to the world. That is why, despite the fact that we had $35 billion of outflow from April 21 to June of 22, we have shown this kind of resilience because the money has also flown from the domestic domestic money has flown in.
Ravi, hi, good afternoon. Would you be at the margin a net buyer of stocks or a net seller of stocks? I mean, booking profits as well. I mean, I think that would also figure, right? If you got in early, made a lot of money at the net level, what are you doing?
So, Prashant, we have been net buyers. We are not net sellers. However, at the same time, there is a lot of churn in terms of what kind of in our portfolio composition has undergone kind of a shift. When COVID struck, at that point of time, we were actually very bullish on themes like pharma, chemicals, IT platform, capital market related companies. Those kind of companies have actually, so what we realized later on is that there was a lot of one-time component to the growth that they saw. And they saw not only top line growth, but margin expansion as well. And then those inflated profits were getting higher multiples. So what we did is actually scale down on the exposure over there. And we added a lot of domestic cyclical exposure. So financials, real estate, manufacturing. And manufacturing encompasses a broad range. I'm talking from auto components to defense to capital goods, engineering. Everything comes under that thing. So that way the portfolio composition has changed, but net we have been buyers in the market.
Yeah, all right. Hi, Mr. Dharamshi. Good speaking to you. The last time we chatted, when we spoke about the real estate space, you were talking about home first finance. Stock has done pretty well. I mean, it's a little higher from when we spoke last. But talking about being bullish on the real estate theme, what about cement? Stocks, the way they are flying, they expect the new entrant to come and buy most of those companies. Have you all played that theme, particularly with regard to those mid-cap companies out there trading at valuations that are far lower than replacement cost?
So Nigel, I'll have to admit over here, we don't have any exposure to cement, and it seems like it's a mistake, but honestly, it's more because our mind is not prepared. So, but from whatever I have seen, it's essentially an entry of a new player that is going to lead a consolidation in the sector. And once that happens, if the consolidation gathers pace, then clearly the pricing power will come back. One thing that we have seen is that the overall utilization levels in the cement X of South. See, South has always been on the lower side in terms of utilization, but X of South, the utilizations are touching almost 80%. And whenever that happens, some amount of pricing power comes back and new capex is announced in the cement. So cement seems to be in a favorable cycle. And of course, on top of that, all the infrastructure spend that the central government as well as the state government is going to do will give a boost to the demand. And right now, monsoon season is going on. Once that is over and the festive season kicks in, some amount of demand will again come back into the system, and that should be the real, first sign that the demand is actually holding up, and in fact is way better. So we don't have any exposure to cement, but I have a kind of a positive bias towards it.
Okay, positive bias. Well, just look at ICICI Bank, by the way, because it's the leadership stock, and it's at the low point of the day. Second day running that, it's almost there at the closing hour. Sometimes you just want to give importance to these anecdotes, but that's drag the market slightly lower once again. So just keep an eye on this. Ravi, in the banking pack, clearly there's been such a massive leadership change. What kind of stocks would you buy at current levels, if any?
So the thesis remains quite clear in financials. You want to go with people who, the banks where balance sheet cleanup is behind you, management uncertainty is behind you. There is no overhang in terms of a stake sale or anything. The current ROEs, ROCs are reflect more like 10-12% range, and there is a scope for leveraging the balance sheet. So if you can see a clear path of ROEs going from 10-12% to 15-18% over the next 2-3 years with a 15 to 18% kind of a growth in top line, I think those are the banks that you want to be associated with. Without naming any, I think one of the larger names, the story is very clear. Again, just like India, this particular bank also saw cleanup much ahead of the rest of the banks, and hence it is actually seeing, kind of the leadership has changed. And some of the old leaders are actually facing issues because of the management change, merger, which is not actually giving a clear picture as to how it is going to pan out over the next from next 12 months point of view. Beyond that, even those banks might be a good play.
Were you referring to IndusInd Bank by any chance, Ravi?
I will not name anything.
Okay.
Okay. Will you name anything in defense as a space, Ravi? I mean, you like that space, and the stocks are up this year alone. They're up 100, 150% in some cases.
Yeah, Prashant. So I'm very, very bullish on defense space. And see, this is a completely new space. There is not much coverage. This is exactly like how chemicals was in 2014-15, when people didn't know that a sector called chemical existed. There is not much brokerage coverage. Of course, in the last few months, some brokerage coverage has come back. See, India is at the cusp of a manufacturing renaissance. And within that, defense is actually taking a lead role. So defense and renewables are two spaces where there is going to be almost a hockey stick kind of a growth over the next few years. And the order books are built for that. So the problem in this sector was that it was lumpy in nature, because finally it is, for all practical purposes, your customer is government. Okay, whether it might be various government agencies, but it's a B2G business. So that was the problem. And second problem was that the payment always used to be delayed. Now the payment cycle has improved dramatically, and government has provided a lot of visibility in terms of next 3-4 years business. So the lumpiness is gone. And apart from focusing on Make in India and Atmanirbharta push, there is also, they have actually this list that they have come out with, where they have banned some 400 odd items from import. That is like a real kicker. So now there is no choice but for whether it is Army or Navy or Air Force to actually procure these things locally itself. So this is a big push. There might be a delay of a year or so, but for sure domestic defense manufacturing is going to pick up in a big way. The last year exports that we saw of about 13,000-14,000 crores is also a big number. We have not had that kind of export. So it is not only a domestic demand, but it is also some amount of export. And the size of the companies over here will change multi-fold over the next few years. So no doubt that the stocks have run up, but please, I mean, it's a wait for an entry point, but it's some sector that requires an exposure from the next 3, 4, 5 years point of view. One should have exposure to it.
Okay, all right. Mr. Dharamshi, before we let you go, with defense is a little bit more tricky, because if I try to zero down on what you're buying, some of those missiles and all the names are quite complicated. So let's not get into that. But the broad sense that we get is you're bullish on the theme. Final question, pharma, you said you'll pull back some bit of the exposure. You're playing more on the domestic theme, and you've said that you've maintained that consistency over the last few times we caught up as well. What about IT? Still more pain out there? Any exposure?
Yeah. Nigel, I'll just address your defense part a little bit before I go to the IT part.
Please go ahead.
On the defense side, actually, the way we think about it is, so there at headline numbers, it is not actually visible. Of course, there is a allocation increase, but most of the allocation is actually going towards paying salaries and pension. But if you drill down, remove the revenue capex, items, and focus only on the capex items, then you will see that actually the play has to be Navy and Air Force. These are the two arms, of the government that are going to spend a lot of money. And the companies over here are very, very small in comparison to the opportunity. So without, again, naming any companies, I would say focus on companies. Those are addressing these two particular opportunities, Navy and Air Force. And again, offset partners are something that is going to become a big theme over the next few months, as a lot of these companies, just like we saw in this PLI in the electronic space, where the companies changed league in a span of 3-4 years because of the mobile and AC manufacturing and all. Similar thing is going to happen in the Indian offset space also. These small companies with 500,000, 1,500 crore kind of turnover are going to end up becoming 5-10,000 crore kind of turnover in a very, very short period of time. So that's on the defense. Coming to your question on IT, I think, again, we missed the IT rally from IT services rally in 20 and 21. But at the same time, we have still stayed away from IT purely because we believe there was a lot of room for margin. Margin expanded a lot because of travel costs being low, because of the pricing being favorable. Now those things are not there. The pricing has become unfavorable, as in the prices are eroding. Travel costs have come back, and there is a lot of attrition. So there is a good amount of pressure on the margin, and the demand, of course, is growing, but it is not growing at the kind of bunched up demand that we saw because of COVID and digitization. So I think there are some challenging quarters ahead for IT. Maybe 2 to 4 quarters is what I would say. But again, this remains an all-time green space, and we would be looking to, always have a kind of a play at some point in future.
All right.
Just one thing, Ravi. Sorry, just on defense. Just to go back to defense, do you think from here there is a lot more, because it's the trick always is to kind of figure out how much is in the price, right? Some of this growth that you were talking about, or you think? Sorry, go on briefly.
No, absolutely. I think these companies are going to change orbit in a big way. See, when we started tracking, just to give you an analogy of another sector that will put things in perspective, chemical stocks were trading at multiples of 8, 10, and the growth that they were showing was 12, 15% kind, and the margins and the ROCs that they were making were decent in terms of 15, 16%. But what happened over the next 5 years is that the growth shot up to 25, 30%. The margins expanded from to almost 20, 25%, and the ROCs expanded to 35, 40%, and the multiples consequently went from single digit to now 35, 40, easily sustainable. So that is the kind of re-rating we saw in that sector. So when a large opportunity meets a small sector, and when I say small, it's the size of the companies in absolute terms are very, very small. All of these companies are still at, and I am barring the few large PSUs I am talking about, the companies are still in 1,000, 1,500 crore or sub 1,000 crore kind of turnover. These companies will change scale in a big way over the next 5, 7, 10 years. So there will be margin expansion, there will be re-rating happening. In fact, still some of the large PSUs are still quoting at sub 15 P multiple. So you have to kind of keep that anchor bias aside and focus at it from the next 3 to 5 years point of view. You might be paying upfront for a year's growth, but I don't think the story is over yet.
Okay, we'll leave it there today. Ravi, thanks a lot for joining us. Good talking to you as always. While that conversation